When I buy a mortgage, most likely I'm going to just collect payments and that's going to be it. It's kind of boring, right? But it's money that comes in every month.
Welcome back to the CashFlow podcast, the podcast where we talk about turning properties into profits. I'm your host, Jason Yoss, and today I have a special guest with me, Mr. Desi Arnaz. Desi, great to see you again.
Jason, it's great to see you too, and it's great to be here.
I'm so excited that you came in. We have chatted before. You're somebody that I really look to in terms of inspiration and like mentoring others on the path to financial success. So I wanted to have you to come in here to kind of talk us through and our audience about, how it is that you can be successful. And later on, we'll talk a little bit about how you can help make your family successful as well.
Oh, okay. Well, you're talking about two of my favorite topics.
There we go.
Me and me.
Me and me?
Just kidding.
Yeah, hey, I can't get enough of me and me either, so I'm with you. Let's start with the beginning. Everly Mae Capital. That's your firm. Talk to me a little bit about how long you've been having the firm, how long you got into the business, how you chose this niche.
Okay, great question. Everly Mae Capital is actually our family business. It's a family-owned business. Right now we have about 8 employees. I think half are family and half are not. And I kind of grew into that business by necessity. Because I started investing in real estate mortgage notes about a dozen years ago, and it just grew. I started off buying one note here, one note there, even just a partial, which means like not an entire mortgage. I would just buy a part of it. And now, because of the big demand for this, I decided I needed to go bigger. And so we started this company for that reason.
Talk to me about some specific generalities. For those of us who don't understand what a note is, what a mortgage note is, just give me some basics so that myself, the audience, can understand what it is that you're investing in.
Okay, good. Well, you know what? Here's what I can tell you. I started off, like many investors, investing in real estate. Way back before you were even born, I'm sure. 1980, 81-ish, I picked up some property and started investing in real estate. At that time, I owned a Century 21 franchise too, so I was in the game. And what I was always looking for, though, Jason, was passive income.
Right.
You know what I mean? It wasn't my goal to try to buy a property and then necessarily sell it for 5 times what I paid for it. My goal was to get this income that comes in for the rest of my life so that I don't have to go to work.
This is a good goal, by the way, to make investments where you don't have to go to work.
Yeah, that's the name of the game for me, financial freedom. And so that's what I did for 33 years. And then I discovered mortgage-backed promissory notes. And basically what that is this. A promissory note is nothing more than an IOU.
Okay.
So if you're going to go and buy a house today and you had all cash, basically what would happen is you would write a check to the seller of the house for the cash. They would give you 2 documents. They would give you, they give you 1 document. They would give you a deed to the property, and they would give you keys to the property.
Right.
And that's it. You're done.
Right.
However, if you don't have the cash, then you need to go and bring in a third party, like a bank or some other institution, that'll give you the money so that you can give to the seller.
Right.
And if they're going to give you money, these institutions will require you to sign 2 documents.
Okay.
Primary documents. You're going to sign a lot of them, but the primary ones are these. A promissory note, which is basically your promise to pay them back.
Right.
And then another document called a mortgage or a deed of trust, which is basically saying, if I don't pay you back, you can take my real estate.
Perfect.
Okay? So what I didn't know, though, Jason, even though I owned a mortgage company, I've owned 2 different mortgage companies, I didn't know that I could actually buy that debt that the bank that you signed with the bank, I could buy that debt and I could invest in that debt. And I learned that about actually now 13 years ago.
So what you're saying is that from a true passive investment standpoint, you now are the person that would hold the loan and that borrower would be paying you the money back, the principal plus an interest amount every month.
Every single month.
That's
It's mailbox money.
And the only hiccups come in when people don't pay? Is that what I'm assuming? Or are there more than that?
There could be more than that for sure. You know what I mean? It's not a perfect investment vehicle,
Right.
but as far as investments go, it's one of the closest to perfect in my opinion. But it is an investment.
Right.
So that means
There's risk.
Exactly.
Now, I totally understand where you're coming from. I usually think like, okay, my loan is by the bank, like B of A or Wells Fargo, or they have the loan. So you're saying that you can purchase individual. Now, why or how are you able to acquire a deed of trust or a loan? Like, how do you get that? Why,
Yeah.
I would think that B of A has them all or Wells
Yeah,
Fargo.
they do. They do. They have them all. And generally, when I first started, what I was doing is I was walking into these institutions and heading to the various departments that sell these documents on the secondary market.
All right. All right.
Have you ever heard of Fannie Mae?
Absolutely.
Okay. Well, back in 1938, Congress approved the creation of Fannie Mae. And Fannie Mae's charter was basically to create a market where mortgages are bought and sold, like the stock market where stocks are bought and sold. So Fannie Mae created this market. And for those of your listeners that have ever had a mortgage on a home, they have probably received a letter at least once that says, your loan has been transferred
That's right.
to another lender.
That's right.
What they're really saying is your loan has been sold, but they don't want to tell you that. They just says transferred. Starting next month, please pay those guys, right?
Got it.
Well, I could be one of those guys
Right.
that you're paying.
Let me ask you this question. What is the main reason for having a secondary market for selling a note? So B of A gives me the loan, and again, shout out to B of A, right?
Yes.
B of A gives me the loan, and so now I've got my home, and let's say I've got a $100,000 loan. What is the purpose of them selling that on the secondary market? Is there a profit to be made? Give me a little detail on that.
Generally speaking, what will happen is these lenders will hold on to these mortgages for a while because when you originate a mortgage, meaning when you originally take out a mortgage on your home, you remember you paid a lot of closing costs,
Yep.
right? It's usually a lot. And all that money, most of that money goes to that lender. So even though they may have loaned you $500,000, you just gave them back another $30,000 in costs and fees, right? So they just made 30 grand on this deal right up front. And then they're going to hold on to it for a while. And when you pay a mortgage payment, the early months, the payment is primarily interest.
Right.
Very little goes to pay off the loan.
Right.
Interest is profit for these lenders.
Absolutely.
That's all it is.
Absolutely.
Well, if the lender holds on to that mortgage for a period of time and they've already made $30,000 up front, and now they're collecting this profit up front too each month, there's a point where they may want to recapitalize. In other words, they need to have more money back into their account so they can do another mortgage.
Right.
And so they'll sell their position in these existing mortgages. And that's where I step in and I collect those payments for the remainder of the 30 years.
So what you're saying is that by a bank or an institution loaning the money, they make interest and they make a profit up front. But in order for them to free up that capital to go make more investments, they need to sell that loan on the secondary market.
Yes.
And that's where somebody like yourself or Everly Mae
Yeah.
Capital will come in and purchase that loan. And now you're the servicer and you make the principal and interest. You receive all that. Is that correct?
You bet we do. Yeah.
And what is the strategy for your group when it comes to buying notes? Like, what are you looking for?
Yeah. Well, I like to buy notes in states where the foreclosure process is easy.
Yeah, right.
Okay.
Sure.
Because some states are not. Frankly, some states are kind of cumbersome for a lender, and I don't want to go there. For example, in the state of New York, it could take up to 5 years to foreclose. A person could live in the house for 5 years without making a payment. To me, that's just ridiculous.
Yep.
As a lender.
That's true. True.
as a
We
lender.
have the same issues on the landlord side. There are states like New York that take forever
Yeah.
to get your property back in the event somebody doesn't pay rent. So that makes sense. We're looking for states where the foreclosure process in the event somebody doesn't pay the mortgage isn't so arduous.
Right. And here's the good news, though. 97% of the people in this country pay their mortgage on a regular basis.
Got it.
The default rate is about 3 to 4% nationally, and within our portfolio, it's a little less than that. So I know that when I buy a mortgage, most likely I'm going to just collect payments, and that's going to be it.
Right.
It's kind of boring. right? But
Right.
it's money that comes in every month.
Got it. And are you, when you're raising capital to purchase these mortgages, are you buying a tranche of notes or are you buying one specific note? So, hey, we found a property that the note is up for sale and we're going to buy that one. Or it's like, hey, we bought a portfolio of notes. Tell me your process
Yeah.
on that aspect.
Well, initially, when I was buying one at a time.
Sure.
Because that's all I could afford. As a matter of fact, I couldn't even afford that. And so what I was doing is I was partnering with people.
Right.
And maybe 2 or 3 of us would put some money together and go and buy one, you
Right.
know. But now what we do is we raise the capital, and then we go out and we buy them. We buy them in what you call tranches. You know, for the public out there, I'm saying we buy by the case.
There we go.
And sometimes we'll sell these off, and if we do, we'll sell them by the bottle. Right? We
Really?
can mark them up, right?
I
And
love
so
it.
For the person that says, I just want one. And so sometimes I'll sell off one because I can make a nice profit on it as well.
Sounds like a great idea. It's the same thing that we would do in the supermarket buying a case of beers. That's right.
Yeah.
So what do you do to evaluate? I know I kind of caught you there a little bit by saying we're buying in states that are a little bit less arduous to foreclose on. But what other things are you looking for in a property?
Yeah.
I'm assuming, but you tell me if I'm wrong. The last thing you want is to have to foreclose on a property, or do you find it sometimes it's advantageous where, hey, if the property doesn't perform, or I'm sorry, if the borrower doesn't perform, we're going to get a nice piece of property back.
Yeah. Well, I always take a really close look at the property, even though I'm not buying the property.
Right.
Because I ask myself this single question. If this person stops paying, do I want that house in that neighborhood on that street?
Right.
You know what I mean?
Yep.
And there are some streets I don't.
Yeah.
And I don't care what you offered the note for. I just wouldn't buy it.
Right.
And then there are others that I'm okay with that. And so what I'll do, though, is before foreclosing, because that's always my very, very last thing, I don't invest to own the real estate. Right. There are people that buy mortgage notes so that they can actually foreclose.
Okay, got it.
That's their goal. They want the property. But the buying the note is the backdoor way in to get the property. I don't want that. I just want the cash flow. And so what I'll typically do if people fall behind is I'll reach out to them and I'll find out what's going on to see if I can help them. Oftentimes I'm able to maybe take a few payments and put them on the back end of the loan, extend the loan out an additional 3 or 4 months. Right. And that gets these people back on track and paying again, you know. Sometimes I'll give people money to move out and they can walk away from the property so they don't have to have a foreclosure on their record. I'll give them something called cash for keys, right. You know. So people do that. But at the end of the day, if none of that works, then my only option really is to take the legal procedure of going through the foreclosure process, which in most states takes about a year. And I have no income coming in during that time, but I have expenses going out. I'm paying lawyers, right? I'm paying taxes. I'm paying insurance. Maybe if the property's vacant, I may be paying to maintain the lawn. Sure. I was going to say the garden, but I'm not from England. So the lawn.
Right.
Okay.
Keep it from being a constant break-in and magnet
exactly.
for transients. Yeah, that makes sense.
Yeah. So.
Let me ask you this question before we get into some case studies. What kind of percentage, what kind of profit are we seeing in this? Like, again, using just a simple number, like if I'm buying a loan of $100,000, am I typically getting a 6, a 7, an 8? I'm pretty sure that rates were at 3%, like not too long ago. So what kind of profit do we see from this?
Okay, well, that's one of my favorite things about investing in notes, okay? It doesn't matter where the market is, okay, from my perspective, right? Because when I buy a mortgage note, a contract, I call them contracts, but when I buy a mortgage contract, I negotiate a price that guarantees that my return will be at some minimum threshold.
Sure.
So in other words, if let's say you do have that $100,000 loan and you have a 5% interest rate.
Okay.
If I pay $100,000 to B of A to buy your position, then I'm earning 5% on my money.
Right.
But if I pay $80,000 to B of A to buy your $100,000 loan, now my $80,000 is earning more like 9 or 10%.
Right.
Right? And so that's what the discount does for us. And so we buy everything at a discount. Typically, we'll buy mortgages where we're earning always double digits. It's going to be 11 to 16% is what we're earning on the investment that we actually make.
Right.
People say to me, how can a person be paying 5% but you're collecting 11%? I say, well, if you understand how money works,
Yeah.
it'll make complete sense.
Right.
But that's the reality of it.
Yeah, no, that's a great aspect that you pointed out that I wasn't thinking about is you're not necessarily paying face value for that loan, right? That mortgage note. So I really appreciate the way you're breaking this down because somebody who colors like crayons or with crayons like me can understand it. And I know that a lot of our guests will. I want to get into a couple case studies, a couple examples of notes that you bought or portfolios that you bought or that you're currently buying, just so that the audience can get a better idea of like exactly what it would look like if they called and said, Desi, I want to invest with Everly Capital Group.
Yeah. Okay. Yeah. So here's basically what we do.
Okay.
I have relationships with banks, hedge funds, and mortgage note brokers. There's a whole network across the country of people that find mortgage notes and then bring them to us, right? And so when they bring them to us, I have a team of people, we call it our due diligence team. They go into it and they look at each asset to determine if we want them. Right. Because even when we were looking at a pool, right, a case of these, sometimes we have the option of saying, nah, there's 20 in here, but we don't want these 3. Right. They're in the wrong place. But whatever, they're in the wrong neighborhoods. So we can do that. So anyway, we look at each of those and we make a determination as to whether or not we want to buy them first. And then if we do buy them, what we're willing to pay, okay? And then we get local real estate appraisers to go out, or real estate agents, either one, to go out and tell us what the property is worth, give us photographs of the neighborhood, because we want to know, right? I'm not going to drive or travel to these locations any more than B of A does. Right. So with technology today, Jason, I can do the same thing B of A could do. They never go out and look at the thing. They send out an appraiser. Right. Well, I just send out an appraiser. I mean, it's really that simple. Right. And the same thing with the title, right? We get title work done so that we know the title is clear. Right. And then we also get the pay history of the homeowner. Okay. To me, that's really vital. Sure. I don't care about their credit score, unlike a lot of lenders. Okay. What I care about is, do they pay their mortgage? Right. Because the reality is that there are people out there that pay their mortgage no matter what happens in their life. And then there are other people that pay their car no matter what happens in their life. That's a great point. That's a great point. I think that's probably one of the most important things said in this conversation is that you're not looking at their credit score because they may say, I can't make the Macy's payment today or I can't make the Target credit card payment today, but I'm 100% going to pay my mortgage and I'm going to do it every month on time. And if that's what you're investing in, it makes sense to be focused on that and not do they have a 700 credit score or not. Who cares? Yeah. I got an offer this past week from someone with like a 450 credit score, but they had been paying their mortgage payment. They never miss. Wow. They just don't pay anybody else. I like that philosophy, by the way. I like that philosophy, by the way. It's okay with me. It's such an interesting way to go about investing. And again, what do you currently have on your plate right now? What are you looking at? Where are you looking at? What's got your interest peaked right now? Well, my interest is always the same, and that is this. I'm looking for mortgages primarily I like the Southeast. Okay. And I like Texas, and I like the Midwest, some of the Midwest. So I'm looking for mortgages there. And anything that I can buy within those communities, I will typically make an offer at least. And then I'm also looking for investor partners that want to partner with us on these mortgages. And so what we do is we actually pay our partners, since we have cash flow coming in every month, we can actually tell our partners, unlike stocks, you're going to get paid every month. Yeah, you're going to get some money. Yeah, you're going to get some money. Because we know it's coming in. Mm-hmm. We know that our portfolio is performing at 96, 97, 98% efficiency. Wonderful. And when it fails to perform, we know what to do about that. And, and it's easy. It's an easy fix most of the time. And so we're looking for people that want to do that. And we also share our profits. Once a year, we share profits with our investor partners. So they get the monthly and they get the annual profit kicker too. Got it. So what I'm looking for at the end of the day is more assets like that, more assets, primarily single-family homes, small commercial, depends on the type of commercial, but multifamily is, what I prefer.
Like 1 to 4, or do you tend to go over 4 units?
Larger, yeah.
Okay, well, larger then.
Yeah,
Okay.
yeah, larger
So more in
than
the
40.
boutique space, 5 to 50 or so.
Yeah,
Okay,
right.
got it.
Yeah, that's a good spot. That's a
like
nice
that.
sweet spot, and we can get good deals there too. And oftentimes, if they're, we can get cash flow on those. And if they fail to perform, we just step in, and there's clauses in these mortgages that allow us to step in and collect the rents.
Okay, got it. Got it.
Even
Absolutely.
though we haven't foreclosed yet,
Sure.
we can collect the rents.
In terms of the investor or the client that works with Everly Mae, is there a specific that you're looking for? I mean, you've talked so well about the passivity of what you're investing in. Like, unlike rental property, where you actually are working, even though they call it passive income. I don't know why.
Yeah.
This is truly like invest and then get a check. What type of client are you typically working with?
Yeah. Well, the typical client is a person is normally a professional.
Mm-hmm.
They typically have a retirement account and or a savings account.
Okay.
Like an IRA, 401k, that kind of
Sure.
a thing. And they'll normally we have a minimum investment requirement of $25,000.
Sure.
Okay. So that's what we're looking for. People that can meet that criteria. They don't have to be accredited.
Okay, so they don't have to be accredited investors. Okay, wonderful.
Not anymore. Initially, we only were accepting accredited investors.
Okay.
Meaning wealthy people.
Right.
However, we had our securities attorney go back to the SEC, file the paperwork that was necessary so that we could bring in non-accredited investors.
Wonderful.
Because I grew up very non-accredited.
That's a great descriptor. Like.
Yeah, very non.
And so you're able to open the doors to non-accredited investors. And $25,000, it is, let's not discount and say that's not a lot of money. It is a lot of money for a lot of people.
Yeah.
But it also is a great threshold to get in the door and make passive income.
Yeah. And it's amazing how much $25,000 will grow to, especially if someone's in their 30s. And I have this example that I show on my YouTube channel of a 20-year-old that was going to go out and buy a car. 21-year-old, I think, is in the example. He's going to go out and buy a car for $30,000, right? And pay, let's say, $500 a month or whatever.
Right.
And I show in this example how if this person were to just say, okay, I'm going to drive a hoopty for a while, right?
I'm going to put a small amount of the hoopty and the rest in an investment.
Yes. Well, take that same $500 for 5 years.
Yep.
And just put that away for investing, and then invest it all at age 30. And don't put another dime in. They would retire with more than $1 million investing in our fund.
It's amazing.
I know. It's amazing. And so I say that car didn't really cost that person $30,000, did it?
Yeah.
It costed them $1 million.
Yeah.
Because they didn't quite get it.
What's your biggest challenge then, or what common questions do you get? I mean, I'm sure a lot of people are like, Desi, this is not right. This can't be real. What's the secret? What's the trick buyer? What are you usually coming up against that objection, and how do you have to handle
People
that?
saying, if this is so good, how come I haven't heard of it in the past? And how come nobody's doing it? And I think if you understand the history of this, it'll make sense. So do you mind if I share the history?
I would love to. I'd love to.
I mentioned earlier that Fannie Mae created the secondary mortgage market back in 1938.
Right.
Okay. Well, from 1938 to 2008 or 9, when the crash happened, right? Pretty much the only people trading in that space were wealthy individuals, big banks, big insurance companies, people like that. Because they had a system in place that was designed to handle up to, I think, 6%, 5 or 6% default rate.
Okay.
They had enough infrastructure, enough employees, but we all know what happened in 2008. The default rate,
6%,
it got way above 6%. The default rate went up to over 20%.
Wow.
20% in most parts of the country, and literally they were overwhelmed. And so Fannie Mae, during that time, decided we're going to open up the secondary market to people that are not rich already.
Right.
Okay, we're going to open it up to the rest of us.
Right.
And that basically gave us an opportunity. So even though this has been around almost 100 years, it's still relatively ground floor.
I love it.
Yeah, and people don't know about it. And so that's why I love this opportunity, Jason, because I'm trying to spread the word to say to people, look, you don't have to put your money on Wall Street.
Right, right. Absolutely.
You know, there's better options.
Backed by real estate, backed by actual product, not paper.
Yes, backed by actual products. where you can invest with certainty. You know, when you're investing in these products and you know, for example, I mentioned earlier that when I buy a mortgage note, I buy it at a discount.
Right.
That means I know my minimum return. I know what it's going to be.
Yep.
Okay? It only gets better from there. And I don't want to make this sound harsh or anything, but when a person doesn't pay their mortgage and I wind up with that real estate, it's like hitting a grand slam in baseball. It's like I knock it out of the park.
Yeah.
My returns, I'll just say this, my returns are so high, I'm embarrassed to tell you what they are in those scenarios, but they are huge, huge returns.
Recovering the property, and now the loan compared to what the value of the property is probably quite a spread, and so a minimal work to get it back on the market and get it sold. It makes sense why you said before, it's kind of a back door into buying property, although your goal is to buy notes for passive income.
Yeah.
100% the idea that people don't know about this so that it's not a legitimate investment strategy is just bonkers. That's crazy. And I love the way that you broke it down too so that we can actually understand. I want to, close with, two questions. The first one is, how are you able to take all your years of knowledge, both on the real estate side and now on the mortgage side, how are you able to pass this along to your younger entrepreneur generations?
Yeah, that's really important to me. I do it through several things. One of the things that I do is I invested with my son-in-law in a school that's called Note Investor University, and so people can go there and learn about investing in mortgage notes.
Note Investor University.
Yeah, .com.
Okay, awesome.
Yeah, and it's only like $97 a month, right? And they can learn about investing in mortgage notes.
Right.
And there's no contract. So that's one of the things that I do. But also, I have a podcast.
Yeah.
Yep. It's called the Freedom and Prosperity Podcast. And on that podcast, I talk about all things having to do with freedom and prosperity and wealth and those kinds of things. And then I have a YouTube channel. It's called the Desi Arnaz, right? The Desi Arnaz, I think is the way I'm supposed to say that. And then I mentor people. I mentor people one-on-one. Generally speaking, the people that I mentor, though, we partner on something. I find that's the best way to mentor. That way I know they have some skin in the game.
Right.
So they
otherwise it's just words going out.
Yeah, exactly.
Right.
So they come in and they say, hey, you know what? I have, $25,000, $15,000, whatever. And I'd like to get started investing in notes. Would you mentor me? Then instead of paying me a fee to mentor you, how about this? How about we just do a deal together?
Sure.
And I can mentor you and hold your hand.
That's a fabulous way to do it. And the last thing is, and when you talked to me about this when we first met, this really hit home for me. But talk to me about your family plan and how you're structuring wealth inside the family to grow exponentially.
Oh boy. Now we're really talking about something that's close, near and dear to my heart. Once I started creating wealth, Jason, I found myself, I don't know how to say this other than to just say it. I found myself having more money than I knew what to do with. Right. Okay? Because I had so many mortgage notes, people paying their payments every month. Unless you're just going to waste it, the money just starts to pile up, right? And so I would take it and buy more notes, which means I made even more money. And eventually I thought, well, let me do something different. And so what I decided to do is I decided that I was going to create a family banking system, right? And I used the infinite banking concept.
Yep.
But I took it a step further. I took it a step further by combining the infinite banking concept with something called a dynasty trust, which is a trust that lasts for 360 years. And so what we did is we funded our trust. Initially, I funded it with $50,000. We used that money to buy life insurance policies on every family member.
Right.
When we first started, there was 17. Now we have almost, I think, 26, 27, something like that. And more babies being born.
Family's been working.
I know.
I love that.
Yeah,
I love that.
Yeah, and people marry in too.
Yeah.
Initially I wasn't bringing in the spouses.
Okay.
But then I decided, why not? Let's insure them too. So what we do is every single person that's born, adopted, or married into our family gets covered by an insurance policy.
Right.
Now what that means is that every time someone dies, hundreds of thousands of dollars are paid into our family's dynasty trust bank account.
Right.
that money is available for any family member. For example, right now, 2 of our family members are using it to finance their vehicles.
That's right. Right.
So instead of financing their vehicles, for example, with Toyota,
Yep.
and then paying Toyota every month and letting that money leave the family forever,
Right.
they pay it right back to the family bank with interest,
Yeah.
just like they would Toyota.
Yeah.
But now that money is there when they want to buy another car,
Yeah.
or if someone else wants to buy a car. Ultimately, there should be enough money in there for people to buy houses, to pay for their college education.
Right.
And generation after generation, what happens is as people are born, the trust automatically buys policies on every person born into the family.
Right.
And the trust makes the payments.
Right.
And so nobody has to come up with it. So
Yeah.
every family member in my family is now covered by life insurance. And the way that we do it also to make it worthwhile for them is 25% of the death benefit goes to their family. So like if you were my son,
Right.
25%, and let's say we have a $100,000 policy
Sure.
on you, 25 grand, you know your family's going to get 25 grand to put you in the ground.
Yep.
No matter what.
Yep.
Even if you have no insurance, you know that's going to happen.
Yeah, it's gonna cover
Yeah. And the other $75,000 remains in the family
to
trust.
continue to grow the investment. Yeah.
Exactly. And that money is invested into investments, into mortgage notes.
I love it, and I love that concept, and I think that that is a staple for what more families should be focused on. So as we wrap it up, I want to say thank you, Desi, for coming in.
My pleasure.
Absolute fabulous information. I'm
Yeah.
glad that we could get our audience squared away on how to understand investing in mortgage notes, and more importantly, that family dynamic trust so important. So Desi Arnaz, thank you so much for being here. Everyone else, thanks for tuning in to the CashFlow podcast. We'll catch you next week. Take care.